Bank stocks stumble as 10-year yield hits 15-month low, falling Fed lower for longer policy update. What? We've been told the Feds are going to raise and interest rates are going up. What? Lower for longer policy update? How long have we been told the interest rates are going up? It's nuts. Look, I fell victim for this myself back in 2009, and let's dive into this here, and I'll share with you my own thoughts on this, and give props to a good friend of mine, Rich. Anyway, we'll get into this in just a second. So, Dateline, March 20th, 2019, from Mark DeCambray. Popular gauges of financial institutions on Wall Street traded solidly lower after the Federal Reserve downgraded its forecast for U.S. economic growth and indicated that policymakers wouldn't hike rates in 2019. That reaffirmation of its earlier dovishness provides a poor environment for banks. I don't think it should be banks like that, should it? With apostrophe, I'm not sure. Whose business models perform better in a rising interest rate. The 10-year Treasury fell to 2.53, hitting the lowest level since January of 2018, so over 15 months ago. Let's see. Meanwhile, financial selector, don't care about that. Although the Fed Open Market Committee, FOMC, held interest rates at a range of 2.25 to 2.5 as expected, it downgraded the economic outlook, dropping its GDP forecast to 2.1 from 2.3. Just remember, that's not recession. If the GDP is growing, inherently that's not recessionary. So just FYI. Hey, yeah, it's just... All right, and said that the winding down of balance sheets would end in September. All right, so I just want to point that out. The Fed is not raising, my friends. So the Fed's not raising. So we have a pretty flat yield curve. You're still getting 2.25 on the low end to 2.5, and you're getting 2.53 on the 10-year and about 3% on the 30-year, roughly. You got to stop this thing. The interest rates are rising. You'll see all these mortgage guys, promoting you better refinance now before rates go up and bump. You just don't. I mean, I'm not saying don't do it. I'm just saying you gotta watch this you just gotta be careful. That's all there is to it. We see right now the Fed is not raising. Interest rates have not gone up. The economy is not in a recession because if they're projecting a 2.1% growth, that's not great. We'd love to see 3%. But 2.1 is growing, which means inherently it's not recessionary. So just stop sweating. Now, I will tell you my own experience with this, my monetarist viewpoint of economic policy, which just shows no economist knows what the hell they're talking about. Milton Friedman, Ludwig von Mises, never mind Keynes, and whoever these Marxists that are dominating schools anymore, they know what they're thinking because they just want power, uninhibited power for sure. Marxism leads to power, which means you and I are going to be put up against the wall. All right, but anyway, so back in 2009, I'll never forget, we had USAA had a 10-year fixed annuity at 6%. They had a 5-year fixed annuity at 5.5 and a 2-year at 4.5, I think. So they had these a 10, 5, and a 2. Now you got to be careful when you're laddering annuities. I'm not going to get in that here today, but if it's an outside of an IRA, there are problems in doing that from a tax perspective. But you just got to be careful. But in this case, if it's in an IRA, you're saying to yourself, why not do a ladder at 4.5, 5.5, and 6? And that would have made sense. The problem is I and many others were steering people clear from the 10-year at 6% and getting them to the 2-year simply because rates had to go up, right? When the Fed's spending, I mean, inflation is forever a monetary policy, a monetary problem, says my man Milton Friedman. Well, the facts were the Feds were spending like crazy. We didn't have any inflation. And me and this guy, Rich, the West Point guy, so he's an officer, and I'm just an enlisted. So it's funny. We do these seminars all up and down the East Coast, all over the place, and we'd have these debates. It was in a fun way. He's a good friend of mine in front of the crowd, and he's talking about deflation, the Japanese model, and I'm talking about inflation, the monetarist model. They're saying inflation is everywhere and anywhere a monetary policy problem, i.e., Fed spends more money creates inflation. And Rich would say, what's his name? He said, no, it's not inflation. It's going to be deflationary like Japan. And obviously he wasn't right, but I wasn't right either. We simply don't have huge mass inflation. We don't have deflation, but certainly we're probably closer to the Japanese model than we are to a hyperinflationary model for sure. And so those people who did not do the 10-year fixed annuity at 6%, when that 2-year matured in 2011, they're sitting on, getting 2%, 2.5%, 2%. I don't even think that. I think 1.5% at that point, and that's where we still are today. So if you can get 6% on a guaranteed product by a strong company like USAA, you'd be crazy not to take advantage of it, my friends. I mean, just my goodness, it's guaranteed, it's fixed. I mean, the facts are, you look historically, the stock market has averaged 10, the bond market has averaged 6. The bond markets will not average 6 going forward. The stock market probably won't average 10 going forward. So if you can find yourself with a 6% rate, hop on that sucker like it's no tomorrow, assuming the issuer is good, solid, that's for sure. But you're not going to get that anymore. But I remember I had this one guy, actually, he lived in Georgia here too. Nice guy. He had between he and his wife about $1 million in these fixed annuities. $1 million, man. I was like, and you put them in the 10-year ones, 6%. It'd be like the same thing as having those 30-year Treasury bonds in 1982 at 15.25. Now that sucker's maturing 2019. I don't know this guy's name anymore, but he's going to go back to USA and say, hey, I want to redo my fixed annuity at from 10 years. Sorry, bud, it's probably paying 2.5 now. It's kind of like the guys who bought the 30-year Treasury in 1982. 2011 comes, and, hey, I want to get another 30-year at 15.25. Nope, you're getting 3.25. What? Anyway, so I just thought this was pretty funny. So a couple of things. We're not in a recession. There's no recession. Does that mean it's pending? It could happen. I'm going to do a video here in just a second that shows you why a recession is looming for sure. But as we sit here today, the Feds aren't raising. Rates aren't going up. The reason for this is because of two things. Feds aren't raising on the short end, and on the long end, people always have a flight to quality. When people get worried about economic contraction, be it just a lessening of the growth or a true contraction, recession, never mind a depression, there's always a flight to quality, which means bonds, government bonds, always get a bump up in price, which means they get a drop in yield, which is exactly what happened here today. All right, we'll see you next time.